Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus, actually a special episode. Today I'm joined by our Chief Investment Officer, Brian Durno. Welcome, Brian.
Hi, Mike.
And we're here to talk about tariffs. It's on everyone's mind. As of recording this, I think we've all, Canadians, gone through a very challenging weekend, frustrating weekend, probably even to the point, some of us, angering weekend. When we think about what's going on south of the border, President Trump, threats of tariffs, calling us the 51st state. Like I said, lots of frustrations. Let's try and park that frustration and talk about this from an investment perspective. And so that's why we thought it's very important to sit down, Brian and I sit down and hopefully give some reassurance to folks that this is one of those times of uncertainty when a solid, proven investment approach can hopefully give an investor some solace. So again, at the time of recording this, the tariffs are now off. Obviously, the threat happened, removed for 30 days. And we can have lots of discussions as to whether they will come back, they won't. It's just Trump posturing, what have you. But in this whole context of uncertainty, I guess, Brian, as I think about it, that's the whole challenge in investing. There's always uncertainty. There's different, I guess you could argue, different levels of it. But maybe taking a step back, what are the things you and your team take into account when you deal with uncertainties like this in terms of these, pretty significant tariff, that threat hanging over our economy?
Yeah, certainly the whole idea of portfolio construction, when you have a long-term perspective and you've got a deeply ingrained process that's very logical and repeatable and something that you can depend on, is you're always faced with uncertainty. And most of the future, when so read the press or you listen to people on television, everything sounds very obvious after the fact. And the world, it's much trickier when you're making predictions about the future to have any high degree of confidence. So the first thing I'd say about this specific event is just to maybe check the people you're listening to, just to make sure. The more certain they are about the future, the less you might want to give them credit, because First of all, things are moving very quickly. And the second and third order consequences of these kinds of things make it very, very tricky. And actually, there's an ex-central banker of the Bank of Canada that talked specifically about this, that if anyone thinks they can tell you the specific decimal places on the impacts of a trade war between two nations, they're going to get it wrong. So this is one of those times where you shoot for ballparks and not decimal points. Right. In terms of your estimates.
All right. Are there some things that we even started to do as we face this, call it an increasing era of uncertainty?
Yeah. One of the things we learned from the last time around, with the president in the United States was,
you can say it.
Yeah, I should probably say the date, that it's February the 4th.
Yes, that's right.
Things tend
Back to the future, yes.
Tend to change quickly. But it's just to try to avoid being and reactionary ahead of time until you have facts on the ground that you can analyze and input into your models and your thinking. Because there's a lot of times, specifically with the last couple of go-rounds, where you're not actually sure. So now that even we have the tariff, the 30-day thing, we're still actually unsure of if we end up making it to the 30 days and then what the consequence will be after the fact. And then you have this much harder problem. We saw this actually for a moment on Monday when we thought the tariffs were legitimately sticking that day, and the markets had their reaction. So you got a little bit of a preview of what might occur in terms of market reactions immediately, which was kind of a neat little piece of information. I'm not sure you're going to make major portfolio decisions based on that, but you can see where the markets were the most concerned.
I actually thought, the market reactions were not in terms of the reaction, but it was actually positive. It gave me some hope in terms of, I have a bit of a mantra that sanity always prevails. You just don't know how long it will take to get to sanity, but I thought it was good to see sort of some of the market reactions that were going on both sides of the border.
Yeah. It's remarkable. I've been doing this for about 28 years, and it's remarkable how fast the market digests information now. It doesn't always get it right.
Right.
But the speed with which it digests this information and inputs that into prices is very quick. And that is one of the areas of opportunity where you look, if you have an assessment of a company's fundamental value, and you have an event like this and you make your estimate of what you think the consequence will be, you can compare that to the market price move and see if it's in the ballpark about what you expected or materially different.
Right.
And those areas where it's materially different are areas for further research, because you could find yourself having an opportunity that is legitimately mispriced by the market. It doesn't happen all the time, but that is ultimately why on days like that, it's nice to be in a quiet room.
Exactly. So let's tie it back. We talk a lot about our QSEC, quality sector-based approach. I can't help but think this is a time when hopefully our clients are feeling comfortable that they're sitting in quality investments. They're invested in quality holdings. Is it appropriate for them to have that level of comfort in times of this uncertainty?
I would say for sure. And as a matter of fact, although we would never know the shock that is about to occur ahead of time, regardless of the shock, the portfolio is designed with these kinds of events in mind. The companies underneath the hood have weathered many storms, including recessions, COVID, world wars. You can list calamities that would shock you. And this is just another one of those events. So the portfolio isn't designed to have one kind of environment that's required for us to earn a good return for a client's capital. It's designed to be protected against all of the uncertainties the global economy faces, both on the stock and the bond side, including even something new that we've done in the last year or so in introducing government bonds, which they're not like super high yields right now, but they tend to perform very well during surprise shocks like this. And that is precisely what happened in the early days of Monday morning. There was a flight to safety to some of those government bonds. So it's one of those things, you have it in your portfolio. If we introduce it, we're just sort of pecking away and adding positions in government bonds. It's not there for the, 6 years out of 10 that are perfectly fine. It might be there for the 4 that aren't. And the trouble, of course, is we don't know in advance when those 4 years are going to come. So the portfolio is actually defensive in nature by owning the kinds of companies that can sustain these kinds of problems. It doesn't mean they won't go down, but they'll be able to survive the shock, adapt to it, adjust their pricing, adjust their supply chains, and hopefully be just as strong as they were before the shock.
And that's what's so incredible, because I think, and that's what I love about our approach. First of all, quality companies. Secondly, we do talk about a long-term view to this, and the reason for that, the rationale for it, at least in my layman's terms, it comes down to you can't predict. Like even if you didn't have someone who is as unpredictable as President Trump, it's still next to, I think like you said it, anyone who comes out and says they can predict to, multiple decimal places what's going to happen from a macroeconomic perspective, just in one economy, let alone, let's say, on a global scale, I think is foolish, right? And so you have to have that long-term view. If you're going to have that long-term view, you've got to be holding quality holdings, as you say, that can withstand the test of some of these challenges. For sure, could there be bumps? Absolutely. We've seen it in the past. We wish it wouldn't happen, but it may happen in the near term. But again, back to the long-term view, having the quality holdings again puts us in a position where hopefully the volatility is a little bit more managed compared to trying to predict what's going to happen in the immediate to short term.
Yeah, that's exactly right. And that's right in line with our longer term sort of buy and hold philosophy. Even on Monday, when we had our meeting with the PMs where we were talking about this with other PMs in the room, like that was our Monday meeting. We weren't necessarily bogged down with trying to predict what decimal place the inflation rate would be affected. We knew that generally GDP, inflation, and unemployment, those 3 major macro variables, would be negatively impacted. So that part was probably easy to get. The harder part was, especially when you think of something like inflation, which is getting a great deal of attention, especially in the States. The first order consequence seems clear, that it's negative to inflation. It could be higher rates of inflation for longer. But in Canada, when you start to play out the second order consequences of a weakening economy, potentially weakening economy, it gets a little muddier to know that if inflation will be able to sustain high levels if demand falls off.
Right.
So it's not as easy to predict.
Right.
So then you're left with going back to your models, and ultimately we're bottom up fundamental, investors. So the good news about the timing of this is that most of the Canadian companies haven't reported their Q2 or the Q4 earnings. So we'll get a chance to hear what fundamental consequences there'll be right from management's mouth. But that will be part of our effort in the next couple of weeks is reviewing our holdings, checking what the consequences could be, laying out our potential scenarios of pluses and minuses, seeing how it affects our valuation, and then comparing that to the price that we see in the market today. And if it's about right, then that's a different choice than if it's about wrong.
Right. All good points. One thing that, as we read the analysts, I read the pundits and the like, I think one thing that's not coming up often is, where does the central bank fit in all of this in terms of if, God forbid, this does go through, and you touched upon a little bit, what's the inflationary pressures, and then how, what happens to our currency, what happens, from an interest rate perspective. And again, not asking you to predict because no one can predict, I would say. But I would say, I think that's one thing to recognize. There is a bit of another tool in the toolbox, so to speak from a Canadian economy perspective in terms of, we've seen China do that, obviously very different economic model than ours in terms of what they did almost on purpose with their currency in terms of devaluation to handle the tariffs last go around. So anyway, just more of a statement. I don't know if you have anything else to add on that, but again, we shouldn't ignore what the Bank of Canada might do in this situation as well.
Yeah, well, that's 100% correct, and an important insight to remember that we're not going to sit still. If there are negative consequences to our economy, there is definitely an expectation that the monetary policy would be more stimulative. There's luckily we got rates to a high enough level that there's a room to cut now.
Right.
So I wouldn't be surprised to have, if there were a negative consequence and the tariffs lasted longer, there's a lot of ifs there.
Right.
And if they last longer than we want them to and there's consequences in the economy, for sure the central bank can play a role in softening that blow. And I might add actually, outside of some of the, let's say, troubles on the government side, there's also the possibility of fiscal response where governments can support workers the way they always do during recessions. And relative to the G7, this may not be a popular thing to say, but relative to the G7, the Canadian financial deficit in terms of spending for the government, we have a little bit more room than average.
Right.
So we can actually afford to invest in our economy if something terrible were to happen, maybe more than our peers. So that's also another sort of tool in the tool belt to help deal with some of these negative consequences. I might add one thing that popped in my head when we were describing that is when we think of the stock market, which is of course where we would have our exposure in Canada, the Canadian stock market is not equal to the economy.
Right.
The kinds of companies that are inside the Canadian stock market have generally more exposure to international markets and actually US dollars in some cases. So that the market is very different than the economy. So the first order consequence that you think of may not be the same in the stock market as you find if you're a small business owner that's maybe not as diversified as a great big old, $70 billion company in Canada. And even the currency move, it's just interesting to see the complexity that our currency moved materially negative in the last couple of days. It's been actually moving around with dramatic consequence the last few days, really something to watch. But that also, in any company that's selling into the U.S., that can be a natural cushion to help support their own revenues and their own costs as they bring those dollars back to Canada. So there's just a lot of things going on under the hood.
True. It would be for any U.S. imports coming in, obviously it's inflationary from that perspective. But again, depending how quickly companies can adjust or what have you. But again, it just adds to the complexity in all of this. And I guess that's where I always come back to sanity. Sanity has to prevail. No guarantee that it will and no guarantee as to when it will. But, where I place my own personal, as I went through the weekend, honestly, I thought so much about our clients. I've met so many of our clients who are reliant on that border. And, ever since I was a young man, I was involved. I'm sure you're of my vintage, Brian. You recall the great debates between John Turner, Brian Mulroney, and free trade. And I worked for a company. We wanted to get access to the American market. And back then we called ourselves free traders. It's challenging to see these things. But if I come back to sanity, and, there was a great editorial, which, my understanding, had an impact south of the border, Wall Street Journal, like these tariffs are just point blank dumb. And, again, back to sanity, what this will do from an inflationary perspective in the States. You just have to think, hopefully, that again, reason will rule the day over the long term. So
that does sort of bring us back to the portfolio construction. The names, it's unlikely that you're going to have to change a lot of our names. So we may adjust our weightings or those kinds of things. But the tried and true technique of paying a very good price for a very high quality business is not environment specific.
Right.
So that still remains to be true. As a matter of fact, we might find more high-quality businesses at cheaper prices from an event just like this.
Right.
But the overall clients can feel comfortable that their portfolio is, nobody likes it when it moves up and down like that. But it's designed to withstand that. And if you have that long-term time frame, then that you let the portfolio do its heavy lifting.
Exactly. Brian, thank you very much for this. Folks, especially as you go through these uncertain times that we're all facing, this is the time where hopefully you see the value of the integrated approach. This is where your CPA, your accountant comes in, your financial planner, and your portfolio manager, all three working together to hopefully give you some comfort. Don't hesitate to reach out to them if you have any worries or any concerns as we face these challenges. As always, again, don't hesitate to reach out, and please take care.